Leverage. Well, that was kind of the end of the whack. Well, it never ends. It never ends at all. It keeps going. But you want to take a stretch, take a break for a second. We're gonna shift gears into a little bit of different, still related to capital structure for sure. But if you want to take a break, pause the video, go for it. But if you want to keep powering through, that's what I'm here for. And we'll do it. Go get a coffee, an energy drink, do what you got to do. Well, leverage, right? What is leverage? The default leverage, when we talk about leverage, if I just say the word leverage, that's financial leverage. There are other types of leverage, such as operating leverage. But if anyone or I just say the word leverage, you think financial leverage. Now, this is the process of using debt to acquire more assets. Since it affects the variability of profit, leverage affects the assumed risk and required return. Such, it allows individuals and firms to magnify risk and reward. Let's think about what this is. Now, you've got a balance sheet as a company, and you also technically have a personal balance sheet as an individual. Let's say I only have $1,000 in cash. Now, I put that $1,000 into stock. As such, that $1,000 is the only base I have to increase or decrease. Well, let's say someone says, "Hey, I'll lend you $10,000 at a 2% interest rate or something." All right, you go on margin. Any investors out there? Now you can borrow $10,000. Great, wonderful. Now you borrow that $10,000. So now what happens? Well, you decide to put all that money in the market, invest it. Let's say you were making 5% on the market. So that 5% you were making on the market, you were only making on the $1,000. So that's $50. Let's say a year, $50 a year. You're making $50 a year, but now you took out leverage. Now you have $11,000 in the market, right? That plus that. So let's say you're still making 5%. Good for you. So $11,000, and you're making 5% on that. Well, now you're making $550 a year. Okay, that sounds pretty sweet. But then you got to take into account the fact that you're paying interest on this loan. So it's not all it's cracked up to be. You have a little bit of costs there, but you keep in mind that's only $200. Okay, so it looks like you're making money on this. This was a good decision. Now, I'm not telling you to go out and take out leverage, right? We'll talk about this in a second, the downsides of it. So, right, you're really making $350, but that's still better, right? What did you do? You could say, well, it's free money. I mean, it's technically free, but not free because this is a significant risk. And what is that risk? It is the risk of magnifying those risks and rewards because, well, yes, this is a fixed locked-in rate, right? Debt. But let's say, oh my gosh, let's say you lose 5%. Well, before, if you lost 5%, you were only losing $50. You were only losing $50 of your own money, and you could have paid that down. But let's say now, yeah, you lose $500 of the borrowed money, and you still have to pay the debt. So now you have the same here, right? But it's all the same. So now you actually have $750 you have to pay, and you made nothing out of it. So you see here how it magnifies risk and it magnifies rewards. It magnifies it if you made the right decision, and it magnifies it if you make the wrong decision. As such, like leverage and debt, it's a powerful tool, but you got to be safe with it, and you got to use it in instances where it really can benefit you. So if the assets prove to be fruitful, right, the investments are positive, then it'll magnify rewards. But if the assets that you buy lose value or do not provide the intended value, your risk goes up, your losses go up. But we'll be talking about operating leverage and financial leverage, right, in terms of companies. That was just leverage, introduction to leverage, and let's get to it. Now let's talk about operating leverage. So operating leverage is increased by using more fixed operating costs rather than variable operating costs. All right, well, this is operating leverage. We're thinking businesses, right? Operations of a business. So let's talk about operating leverage, high operating leverage. Well, these companies and industries all have high fixed costs. Airlines have high fixed costs because regardless of how many flights they have to pay right, the fees for operating out of an airport. They have to pay for storage of planes. They have to pay for insurance. There's an insane amount of fixed costs. And fixed costs are great if you're doing really well, but like just like that debt. But if you're not doing well, they hurt you. All of a sudden, all the airlines have to shut down. You still have to pay all those fixed costs. Same with automobile manufacturers. You have a lot of fixed costs, right? You have a lot of salaries you have to continue to pay. You have a lot of utilities, right? Lots of insurance, lots of manufacturing plant costs. And pharmaceutical companies, you have a lot of same like high. All of these are high fixed cost, high capital intensive industries. You have to buy a lot of machinery, a lot of insurance. All these industries require large capital investments or R&D expenditures, right? There's greater risk but greater returns for these industries. So if demand skyrockets, costs are more fixed and additional sales are mostly profit. Now keep in mind, not all the costs are fixed. Airlines obviously have the price of fuel and all that, so just take it with a grain of salt. If demand plummets though, like if we have a recession or something that stagnates and no one can fly or no one needs to buy cars, costs remain the same and profits will drop significantly and become losses. What are industries or examples of low operating leverage? Okay, department stores, grocery stores, retailers. Well, if all of a sudden a department store shuts down, grocery store shuts down, retailer shuts down, I mean, yeah, sure, they still have certain costs, right? Insurance, but it's much cheaper to insure a grocery store than an airline. I can tell you that, not from experience, but that's just a wild guess in my mind. So yeah, you'll lose little bit of money immediately because all your food's gonna go bad. But once you just shut the doors and stop paying employees, I mean, pretty low leverage, right? You're not gonna have much in terms of costs. But as you ramp up production, like your costs increase with your sales. Department stores, retailers, grocery stores, all these industries incur more costs as sales increase. Lower risk and lower returns for these industries. So if demand skyrockets, costs will also proportionally increase. And if the demand plummets, costs will drop in proportion to sales. Just some important points to know about operating leverage. There it is. There it is. Now you know a little bit more about that. You can see some multiple choice on operating leverage. Examples of operating leverage. Let's see. Well, the current year has been a tough year for all businesses. Sorry to hear that, everyone. As a part of its financial analysis, Delta Airlines compared its operating leverage to other companies, including American Airlines and Home Depot. Now, why did we choose these examples? Well, we wanted to compare it to a company in the same industry with the same business model and same type of leverage, and then a company in a different industry. Obviously, Delta flies you from airport to airport. I gotta say, I've started to like Delta a little bit more recently. I mean, I know people say it stands for "Don't expect luggage to arrive," but I've had some good experiences lately. I guess all pretty solid. I guess American's been pretty solid as well. Home Depot. Not that I'm building too many houses or anything, but I guess pretty decent examples all around. All right. Anyway, enough of my findings and thoughts on these. Okay, we're comparing our operating leverage to other companies to see how we're doing, and we'll see this as well actually in benchmarking, right? Financial projection and everything. We want to benchmark ourselves to other companies. Here's the results of the findings. Well, general operating leverage based on the industry. Okay, as we mentioned, airlines have a high leverage, and Home Depot's got low leverage because if they shut down, they just don't have costs. I mean, they have some costs, but not as much as airlines. Okay, well, let's see. Okay, decrease in EBIT and decrease in sales. So if they have a decrease in earnings before interest and taxes, decrease in sales, right? So here we have a significant decrease in EBIT with a 4% decrease in sales. Here we have also pretty high decrease in EBIT and actually the same amount of decrease in sales. And then here we have a really not as bad decrease in EBIT, and actually, we have the same decrease in sales. Now, these were the findings. Now, let's talk about this in terms of a business analysis. Airlines are highly leveraged companies because they have high fixed costs. We know that. We talked about that. As such, it makes sense that both airlines saw much more of a swing in EBIT based on the same decrease in sales among all businesses. However, by seeing that Delta's decrease in EBIT was much more than American Airlines, with the same decrease in sales, we can infer that Delta has higher operating leverage than American Airlines. In the future, Delta will need to generate more revenue to cover its fixed costs. And as a result of its leverage, when the whole market sees an increase in sales, it will see a higher profitability than the other companies. Take that in, take it in, enjoy it, right? Think about it for a second. This is the findings. This is just what we're talking about with it. And when we're talking about leverage, overall, leverage equals more debt. Just when you think of leverage, think of debt. You got more leverage, you got more debt, more debt, more leverage. That's what it is. That is operating leverage in reality. Financial leverage, let's get back to this. Well, I gave you the stock example, but let's talk about it more in terms of debt, right? So operating leverage, we talked about that. That's more fixed costs, right? Debt, I guess, yeah, not necessarily debt, but fixed costs. But debt equal fixed costs. Financial leverage is increased by using more debt rather than equity. Debt requires fixed interest costs, whereas equity may pay dividends. However, dividends are not required, right? But it is a variable cost because if you give up shares of your company and then those shares become much more valuable, you're giving up more value as you do better. So high financial leverage, companies that raise capital through debt more than equity, right? As I said, debt, equity, equity. Whoa, what am I saying? Debt, equity. High leverage, leverage is debt, debt is leverage. These are high fixed costs, right? Again, interest payments are fixed. If these companies become profitable, their capital costs are fixed with debt and will see higher profitability than companies with lower financial leverage. These companies may be at risk of bankruptcy if they are unable to pay back their debt, which would also ruin their ability to borrow more in the future. So pros and cons of high or low financial leverage. Everything that we talk about here, there's no one right answer, right? It's not good or bad to have high financial leverage. It's not good or bad to have low financial leverage. Companies that raise capital through equity more than debt are known to have lower financial leverage. These have high variable costs. If these companies become more profitable, their capital costs came from selling off a portion of their profits through stock and will see lower profitability than companies with higher financial leverage. This is more of a safe option, I would say, because if all of a sudden we go to zero, well, we just gave up ownership of our company, which is worth nothing. If we go to zero, we still have fixed payments of debt. Shareholders share the risk in bankruptcy if poor financial performance were to occur. As such, lower financial leverage through equity could be less risky for a company. Debts get paid back before shareholders in bankruptcy. I mentioned that, and you'll for sure see that in reg, but something to know overall as I'd say actually pretty much in all the exams. Yeah, it's something to know. Fun fact to know. That's financial leverage. Some components of it. You gotta think of some companies that operate in both manners, right? Okay, financial leverage example. Well, Unilever, real company, massive company with a diverse brand of products. Got lots of different products under the umbrella of Unilever. The household products division believes strongly in the future demand of automated vacuum cleaners. Due to this, the division takes out $10 billion of debt to construct 7 new factories across the US. Unilever expects to begin to see the effects of this decision in 5 years. We don't know today. We have predictions, but as you all know, as I know, as everyone knows, you plan and God laughs. God only knows what is going to happen in the future. Well, positive results, let's say that if demand for these automated vacuum cleaners is as strong or stronger than predicted, then Unilever has essentially locked in its costs, magnified its gains, and now can use these gains to pay back the set amount of debt. Now, if demand for these automated vacuum cleaners is weaker than predicted, Unilever has essentially locked in its costs, taken a heavy loss, and has to find money to pay back the debt. Again, you see the pros and cons of each. There's just, but to grow as a company, you need to take on risk. You might think, well, why bother taking the riskier approach? Well, then your competitors are going to take risk, and someone out there is going to beat you and take market share, and you'll lose that way. So it's a rough cut world out there. You gotta stay strong with it and fight. It's exhausting though. Make sure you take a little self-care and rest for yourself. Okay, we've got an example of financial leverage, and then we'll talk a bit more, wrapping up our debt, equity, and preferred stock, and that'll be capital structure. Now, without leverage, so investment company currently, and this is essentially what I was talking about with the stocks, right? You borrowed 10,000 for stocks. So if that makes sense to you, feel free to not do this, but I think it wouldn't hurt if you got the extra time. Listen to me talk about what happens with our extra leverage. Well, investment company currently has $100,000 to purchase equity securities. So without leverage, it uses its $100,000 to buy stocks. If the stocks see a 50% increase, the company has $150,000 or 50 in profit. If they see a 50% decrease, the company has $50,000 loss, or they have a total value of $50,000, right? Pretty simple. That's what happens. You just have the money and you either gain or you lose. Obviously, it doesn't have to go up or down by 50, go up or down by 25 or anything like that. I'm just choosing 50 for this example. All right. Investment company currently has $100,000 to purchase equity securities. Additionally, it could borrow another $100,000 at a 3% annual rate by collateralizing the line of credit with its current holdings. Now, this is real. You can do this. You can, if you have stocks, you can use it as collateral, just like your house is collateral, the mortgage, or you can make your car's collateral and lock in with a bank or something, and they'll give you a cheap interest rate on a line of credit, which just allows you to borrow money as you want. Okay, let's talk about that. So, just like you said before, we've got a fee, right? So if we do well, no matter what, we're paying 3%. But if we do well, it doesn't really matter. If we don't do well, it does matter. Now, with a 50% increase, the firm has $300,000. Okay, let's talk about that. Where does that come from? Well, we had $100,000, then we borrowed another $100,000. That's $200, and then a 50% increase here would get us to $300. That's where we get $300 from. Okay, so if there were a 50% increase, so we have $300,000 now, then we can pay back the original $100,000, and we end up with a profit of $200,000. And then obviously we pay the interest, 3% on that. But no, I'm just not even going to worry about that. No worries. And then keep in mind the firm only had to actually have $100,000 on hand. Leverage magnifies gains. So you see the magic that happened there. Doesn't that sound wonderful? Doesn't that sound like a perfect world? You just make money out of thin air, right? So that sounds great. But on the flip side, if the stocks see a 50% decrease, the company only has $100,000. And it still owes $100,000. Okay, so let's talk about this. So yes, you had 100, you borrowed another 100, so you have 200. Then you lost 50%, so now you're down to 100. You still owe 100 in debt, and you still owe the interest. That does not sound ideal. So you're essentially at zero now in terms of money. In terms of money, we have none. Leverage magnifies losses. Oh man. Well, I can enjoy this because this is all theoretical. If this was happening to me, I would not be laughing and having a good time. But that is financial leverage. Another example of it. Hope you enjoyed. Talk about some last minute debt equity preferred stock. And you may have seen this a little bit ago in the same lesson right here, right? But I just wanted to bring it to your attention again. To be honest, I would kind of memorize this, and if you understand all of this, don't really have to memorize it. This is not something where you're gonna have to spit out these 6, 7, whatever bullet points. You just kind of need to know them. So knowing what's fixed, what's variable, what's a hybrid, the tax implications of everything, when you would want to do one versus the other, how these play into whack, and all of it together, right? So take another good look, enjoy it, and learn from it. But that is debt versus equity versus preferred stock. Sneak that in there. But, I like to just say debt versus equity because preferred stock is kind of its own thing. It's a hybrid. All right, that is it. Enjoy.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.